Ladies and gents, the crash isn't coming. It might already be here. While the media whispers about, quote, soft landings, real flippers and investors are staring down data that says otherwise. So let's skip the spin and break down 5 undeniable signs that the housing market is in full-blown correction mode, and what that means for you if you're flipping or investing in today's market. If you want real-time insights on what to buy, where the best flips are emerging, and what markets are most exposed, subscribe to the Deal Watch. It's completely free. It's our weekly newsletter packed with deals and market data tailored to serious investors. All right, sign number 1, inventory is exploding. Nationwide, active listings are up nearly 30% year over year. You guys have seen my last couple of videos, but in key states like California, that spike jumps to 36%. Sellers are flooding the market. Buyers? Not so much. This isn't just noise. It's the loudest signal that the supply-demand balance has flipped. Properties that used to go under contract in days are now sitting for 30, 45, 60 days. And guess who's listing? Not builders, homeowners trying to cash out while they still can. As a flipper, this is your window, but it's a shrinking one. We're watching slow motion distress, so use it. Sign number 2, price cuts are stacking up. Nearly 1 in 5 homes listed in May had a price reduction. That's the 6th consecutive month of rising price drops. Markets like Denver, Phoenix, and Austin are seeing over 30% of homes slashed, and many of those homes are still sitting without offers. This is the beginning of price capitulation, and smart flippers are jumping in where the comps are weak, the sellers are motivated, and the upside margin is growing. If you want a breakdown of cities where price drops are accelerating, we highlight them weekly inside the Deal Watch newsletter. Click the link down in the description below. All right, sign number 3, seller concessions are through the roof. Nearly half of all home sales now involve seller giveaways, closing costs, rate buy-downs, repair credits, you name it, they're trying it all. In markets like Seattle, it's over 70%. That means the real price sellers are accepting is lower than it appears. And here's the flipper advantage. You can negotiate deals with even more built-in margin than the comp suggests. Just remember, concessions equal stealth discounts. The bottom line, buyers now hold the power. Use that leverage wisely, especially in markets where sellers are bleeding equity but don't want to admit it yet. Sign number 4, foreclosures are creeping in. Over 93,000 properties enter foreclosure in Q1 alone. That's up 6% from last quarter, and it's not slowing down. The worst hit states, Delaware, Florida, Illinois. But what's most important is who's defaulting. FHA and VA loans are leading the spike. First-time home buyers and veterans, some of the most secure loans in the world. That means lower equity, higher risk properties are beginning to surface again, and that's exactly where flippers can win if you know how to structure the right exit strategy. Inside the Deal Watch, we're tracking foreclosure spikes and flagging zip codes where flips with built-in margins are reappearing, so make sure you subscribe to that. Click the link in the description below. All right, sign number 5, affordability has collapsed. Mortgage rates are hovering near 6.8%. Home prices are still inflated. According to NAHB, affordability is back to where it was in the 1980s. And a lot of you guys, young flippers, you're not old enough to remember what happened in the 1980s, but research it. It was a wild time in the housing market. Even if sellers drop prices, most buyers simply can't afford to make a move. So what's happening? Homeowners locked in 2 to 3% rates are frozen. They're not moving. But investors and second home sellers, they're listing, they're exposed, and they're willing to deal. This creates a strange market dynamic. Massive supply surges in certain price bands while others remain frozen. Your job as a flipper is to target the distressed supply that's being ignored by retail buyers. And you guys, think about it. All of the prices surged from 2019 to 2021, and now the market is correcting itself. Now, is it going to crash back down to where it was in 2019? Highly unlikely. But it is a great time to shop because the housing market wasn't ever really worth as much as it jumped up to in 2021 post-pandemic. Look, you guys, this isn't doom and gloom. It's just reality. The media will catch up in 12 months. By then, the best deals will be gone. Right now, the data says we're already in the middle of a slow motion housing correction. Inventory spiking, price cuts growing, seller concessions exploding, foreclosures rising, affordability flatlined. If you want to survive this market and more importantly, profit from it, stay focused, stay informed, and move when others freeze. And don't forget, you guys, subscribe to the Deal Watch. Click the link in the description. The best flips don't sit on Zillow, show up in your inbox. See you over there. Catch you on the next one. Bye.